I think that the best way to do this is have somewhat of the first part of this be an education, and then the second part is to tell you where we at Auerbach Funds fit in. So first, a little about me. Most important, I am a practicing Reformed Jew in the United States. I am a father, I am a husband, I have two beautiful children back home. I love sports, I love to travel. It's my 11th trip to Israel. I was partners with a group here for some years as their chief investment officer. And in my spare time, I love to lecture about finance and real estate. And I think what gets lost in a lot of these pitches is that it becomes all about, I'm going to get you these numbers, this is what's going to happen, and nobody can really guarantee anything. But what gets looked over is what seems to be very complex is actually quite simple, but people are either afraid to ask or don't know. So if you don't mind, I want to take 15 minutes to walk through the structure of a real estate deal. And some of you might know it. For that, I apologize. Does that sound good? Okay. And also, cut me off at any time. If I ramble, please raise hands. It could be a dialogue, not a monologue. So let's talk about the players in a real estate deal. So there are four main players. One is the asset, the building, the piece of land. So we'll call that player number one. Player number two is the sponsor. So what is the sponsor of the deal? The sponsor is the person that you know, and everybody knows somebody that's in the real estate business. That could be a developer, somebody that's building single homes, somebody that's flipping condos, somebody that's buying apartment buildings in the United States, improving them, or buying office building. And that is the captain of the deal. That is the person that puts the entire deal together. The next component is the bank. Most of these things, we're going to assume that these are finance deals for the sake of this exercise. Next is you have the bank. Now the bank, I don't think we need an explanation, lends the money. And there are a variety of different ways to get the money. You have government money, you have fund money, where there are funds like mine that just lend. You have syndicated money, where somebody says, I'm a lender, but they're really not a bank, and they just go to a room full of people and get them to participate in the loan. That's very common in the United States. And last, you have your actual banks, your local banks. And the fourth player in these deals is known as the equity. That's the actual down payment on the home. Everybody knows what buying a home is like. It's a $100 home. You get $70 from the bank and $30 of the down payment. That is the equity. And all of these players dance together to create a real estate deal. And we're going to go through an illustrative example of what this looks like. So we have sponsor. Baruch, you are now a real estate sponsor. And Baruch, congratulations. Welcome. And just for what it's worth, Baruch, have you ever been a sponsor on a deal? Nope. Okay, so never mind. I thought you might have done it once or twice. So sponsor identifies an apartment building, and let's say it's in Tulsa, Oklahoma City. And this sponsor can be one of two things. It could be an entrepreneur, someone that's just putting pieces of a deal together and going to hire out somebody to run the property, hire out someone to do the accounting. These are not sponsors you want to deal with. The second version of a sponsor is a vertically integrated sponsor, a sponsor that is rifle shot on one area or one region that has in-house property management, in-house accounting, in-house construction management, perhaps their own construction team. And the advantage of being localized is that while you are coming up with a master plan of where you're going to put money, these sponsors are fighting the Battle of Stalingrad. They know every nook and cranny of their market. They are going to see those deals. So now Baruch, we're going to assume, is a vertically integrated sponsor. He has identified a 100-unit apartment building in Tulsa, Oklahoma, where he has all of his team. Everybody with me so far? Okay. And it cost $100. And he says, I'm going to put this under contract. He goes and contacts the seller. He has a certain amount of time to facilitate this transaction. So now during that time, he's got to get a loan and he's got to get the money because he doesn't have $100. Baruch's got $3, which is going to be the perfect amount, believe it or not, the perfect amount to do this deal. So he's going to get $70 from the bank. What does that leave in equity? $27, right, because he's putting in 3 himself. So where does he get this $27 from? There are 2 ways. One is a syndication, where he runs out to a group of people and says, you're in for $1, you're in for $1. And under that is the ideal situation for Baruch. Because if you have 27 different investors, you have full control. There's nobody telling you what to do. Also, each of these investors has no real negotiating power because they're coming in for small amounts. So he's going to charge a larger fee. So he's going to charge acquisition fees, he's going to charge asset management fees, and he's going to charge what's known as a promote or a carried interest. And that promote will be after you, the investor, a part of the syndication, receive a certain percentage, then he's going to start sharing in it. He's going to start sharing out of your profits of the $27. And that is 99% of how real estate deals are done. Now we can get more nuanced if you want to call me and how this is done in a partnership structure and he's the general partner and you're the limited partner, but that's a whole different conversation that you probably know a lot about. So the other way that Baruch can get his money is through what's called institutional equity, where he goes to Blackstone, Carlyle, KKR, Angelo Gordon, BlackRock. Any big name that you think is in the real estate business actually does not run the assets. They are equity providers. So in theory, you, the investor, going into Blackstone, BlackRock, are paying 2 promotes and 2 layers of fees. You're paying the sponsor, who's coming from BlackRock, and then BlackRock is charging it. And if you invest with us, you are also paying 2 layers of fees. So that is what we do and what all the big players do for a living, is that we identify sponsors and deals that require money and we fund the equity. Now the advantages for you guys coming into, let's say a Blackstone is having a distressed fund or we're having a distressed fund, is that with, let's say you have $100,000 to put in. Well, you can't go into a lot of syndications with that at $10,000 a clip. By putting it into a fund, you get diversification. Number 2, there is never a capital call in a fund above what you committed to. I'm sure somebody at some voice in this room has gotten that capital call. You put in $100, send more money, send more money, send more money. That cannot legally happen in a fund. You are capped. The fund will have to use its own resources to fund that out of some of the other deals in the fund, etc. What else do you have in a fund? Control. You, the individual, will not have control over the deal, but the fund does. So Baruch, if I'm his partner, I pick the paint color. I pick the carpet. I am on every single bank account, watching everything he does. In a syndication, let's say Baruch steals the money, and one of the 27 people catches him. Well, now what are you going to do? You got to get all 27 people in a room, pick a lawyer, maybe you sue him. I doubt it. And even if you did, by the time you got everybody together, your money's gone. There's nowhere to go. So with institutions, you're never going to see that. There is an expert vetting this deal. What else do institutions do? They decide the food group, the asset type. For instance, we have been allergic to New York real estate and multifamily for the reason that we were worried about rent stabilization laws. What happened? Rent stabilization laws got crazy and everybody lost all their money. Office buildings lost. So what a lot of funds don't get credit for is what they did not invest in. That is critical. Most important reason why we recommend, and again, whether it's with us, Baruch can probably get you into the Blackstone is raising a distress fund. We highly recommend people come in there. I am not paid by Blackstone, but I think we've always crushed them in returns. They will do very well on this fund. Is what do they have an advantage? The number one advantage, by the time a syndicated deal gets abroad, whether that be Israel, China, France, Neptune, Saturn, it doesn't matter. Everybody, every Peter has turned it down. Again, by the time a deal gets across the Atlantic Ocean or the Pacific Ocean or the Milky Way galaxy, everybody that is an expert in that location has turned it down. Second, you are highly likely to be overpaying for the asset. Here's why. I'm a seller. Baruch's the sponsor buying. Baruch wants to buy this for $100. I say, Baruch, how much time you need? I need 90 days. Where are you getting your money? Well, I'm going to syndicate it. Well, if I'm a seller, is that a sure thing? No, I don't know if he's going to come up with the money. Now you have a separate conversation. Baruch, you're going to buy it. Oh, let me get Peter Auerbach on the phone. He's my equity. Now I get on the phone, I've got the capital, right? It's in a fund. And I say to the seller, 30 days. My money is real as can be. Here's our proof of funds. We have 60 transactions done. This is our fourth investment vehicle. We're sitting on $30 million in cash. I'm even going to throw down $1 million deposit because you're in distress. And we can close in 30 days because I have the banking relationship. But I'm only paying you $92. That is the advantage. Any seller that is going to give a great amount of time for this due diligence, which is really not due diligence, it's a fundraising period, they are going to charge a huge premium. You are not getting. Now, there's certainly deals that will come across the pond and you'll win on, but you won't win as much as you could have won. And there's much more substantial risk. If that sponsor wants to make a capital call, who's to stop them? And now there's dilution provisions. With an institution, the institution decides when a capital call is made and the institution steps in. Any questions thus far?
Peter, I want to emphasize one thing, just make sure that everyone understood what Peter was saying. What he was talking about in terms of when you have Israeli sponsors that are like on the other side of the pond who are looking at deals in the United States and then selling them to other Israelis, just like they do, not just in the United States, but also in Ireland and in Portugal and in every other country around the world. You have Israelis that are going there and then trying then to market those products to Israelis over here. So what he's saying is that basically they're coming at the end of the food chain. After everyone else has rejected it or has not been able to finance it, or they're trying, and they're paying a higher amount than what a local person who's in the market is actually paying.
Even more.
And we've seen this over and over again, especially when you have local people who market it as if, we really know what's going on over there, and they're really not. They don't have boots on the ground over there, but they are kind of traveling back and forth and trying to put together deals. It's an extra level of caution that you have to have whenever you're doing that type of investing.
Right. It is possible. There's diamonds in the rough, but more importantly, and I think Baruch said it, and if you get anything from tonight, listen, we're doing very well on our fundraising, but I love to educate. My history is that my parents went through a lot of trouble giving a lot of money to places they shouldn't have. So it's very near and dear to my heart. Baruch said the words, put together a deal. You don't put together a real estate deal. Again, you do not put together a real estate deal. You own real estate. You don't grab one third-party property manager that you Google to manage your property in Miami while you're sitting in Israel. That is not going to work. This is a 24/7 siege on your time. We were talking about bat infestations. You got to get ready for when the bats come. Do you get the EPA out there? Do you get a kid with a BB gun? What does that look like? I'm kidding. We actually did the BB gun. Don't tell anybody, but we did. I was like, there's no way we're really remediating this. Just scare the bats. So I'm on safe soil, right? Let's edit that out of the video. Let's find the kid with it was Tulsa. There's got to be a goy out there with a gun. So that's what we do. Now funds, how do they work? And I'm sorry to not tell you what we do, but this is, I think, more important than anything, is that now you can understand the players and understand what this stuff is. And it's funny, yeah.
You're a hypothetical deal here. This is an existing development, or you're going to build this?
We don't build, but this same thing applies for development. I particularly don't like development. That's controversial. I don't think that unless you're a sovereign wealth fund, you should, or you're the developer, that you should ever develop. Why would I develop for $1 when I could find someone that got in trouble and buy it for 50 cents? You have to wait 3 years at least before stuff happens. You have a perverse incentive for the developer. You ever see these developers walking around in the Ferraris and everything, and all the people are complaining, saying this guy lost me all this money, yet he's driving a Ferrari? Because he is not incentivized enough on the back end. It's all front-ended. He's keeping his construction company employed. And yeah, you have a pretty building. Now, if you're the sovereign wealth fund of Saudi Arabia and you're going to hold something for 100 years and your limited buy pool is 3% returns and you can develop into a 5 and you have the staying power, sure, have at it. But none of us have that problem. Not yet. Maybe we will one day if they find oil under here, but I don't think we're going to have that problem. So, but yes, the same structure applies. The discount will be on land. Now, a lot of times, going back to development, especially in the next year, you guys are going to hear about, oh, I could do this development deal really cheap. This guy's getting the land really cheap. Land's just a component of that. Construction costs are at an all-time high, and it looks like they're only going to get higher. We'll see how the tariffs work out. But that is just a component. Buy the entire building, bottom feed. Why wouldn't you? You win on day one, and even if you don't win, your risk is a lot less. Buying cheap is a lot less risky than building. They're going to have very pretty parties for the building opening, but these are pitfalls to avoid. Good answer? Okay. Funds. So how does a fund work? Very simply. Even this goes, we have modeled our fund, so when I talk about Blackstone, a little bit about my career. I graduated valedictorian and student body president of Lehigh University, where I was given a full academic scholarship. I was in investment banking at Merrill Lynch. Passed through the analyst program, and they kept me anyway because I love doing the spreadsheets. So it was a little crazy. They had this little desk for me. Went to Credit Suisse, where they had never hired anybody that didn't go to business school. I didn't want to go to business school and spend 2 years. So the guy said, why do you want to stay being an investment banker? My answer was, because I want to be rich. And he hired me. It's a true story. It's true. Not because I wanted to do spreadsheets till 5 in the morning. So from there, I headed up financial analysis for Grubb & Ellis, the entire country at 27 years old. Had a team of 47 that was sold in a reverse merger. And after that, worked at a variety of funds, working my way up to chief investment officer, and then starting my own fund. I personally have $13 million in the 3 existing funds. I plan on putting between $4 to $7 million into this fund. For a minimum, I already have 2 in. Just depends what my wife lets me do, how loud the music gets. Will depend on the beat of the music, may determine what the fund is. I love this. This is all I do. I own no stock except for in my kids' college saving programs. I only own 3 other pieces of real estate: a home for my parents, a home for my in-laws, and a home for a nanny that saved my daughter's life. I have no other investments besides this. That's all I do, all I care about, with the exception of God, my wife, and my kids. Okay, so fund structure.
Don't listen to Peter with regards to the average everyday person's need for diversification.
Yes. Well, I am. I got 60. I have 60 assets. I will take the Pepsi challenge with you.
It works for Peter, but it doesn't necessarily work for everyone else. Be careful.
Then again, there's 60 assets in
That's
there
true. There's
that I
that.
stole. So, and I know them. I can change them. I'm not just looking at a computer. But I digress. You do. Stocks are good too.
It's good too.
I'm biased. So, but we are aligned. Let's just put it that way. We're very aligned. I'm going to be in for a lot. This is a good opportunity to buy. So how does a fund structure work?
Skin in the game. That's
Beef at this point. I got the whole leg.
we'll get to the beef. We're still not.
Oh my God, they're feeding me more? So how does a fund structure work? All funds, and this is not just singing our own praises, are partnerships. Blackstone, seriously, this huge mega fund is a limited partnership. That is the legal definition, and it is truly a partnership. So the way these funds work, and we design ours exactly the same, is you are all partners in the fund, along with me, because I put money in. And as such, as these limited partners, you hire two people, a general partner, and that general partner is the sponsor of the fund. And that general partner is entitled to part of the profit share. And they put it all together. In this case, it's also me, and that would be the same with Blackstone. Then the third person in this party is known as the manager. The manager is the person making the investments, and that is almost always the same person as the sponsor or the GP. However, let's make this very clear. It is not Blackstone's fund, it's not Carlyle's fund, it's not KKR's fund, it's not Peter Auerbach's fund. It is your fund. You guys are partners. If you are a member of any of these other funds, you are entitled, and I believe very firmly in this, to every piece of information that is within that fund. If you want an individual lease out of the 1,000 ones, you are entitled to it. If you want to see someone's rent check, you are entitled to it. Why are you entitled to it? Because you own it. You are a partner in a fund, and I encourage you, when you're reading over your legal documents, to make sure that you have those rights, because you should have those rights as a partner. So it is structured as follows. Typically, and we do it right down the middle, there are 3 periods within the fund. Number 1, the fundraising period. This is an arbitrary time in which you can raise money for the fund. Then it stops. Then you can raise no more money for the fund. During these closings, you can take that money that you've already raised and invest the money. So by the last close of the fund, for us that's July, a lot of the money that's already been raised, if not all of it, has been deployed. So you're going into existing transactions, not some pipeline, not what I might invest in. These are assets that have been owned. In some cases, ones that were bought on the first day will have been owned for 18 months. That is followed by a 3-year investment period. If the money hasn't been invested yet, and this is, again, for all funds, the times might be different, but the rules are the same. You can invest this money. If deals are sold, the sponsor and manager has the right to either distribute that money, that means give it out, or reinvest it. That's 3 years. Typically, funds don't distribute during that. We always have, we always will. Once we start, we don't stop. After that, you have a hold period, which is typically 5 years. And it says, wow, that's a long time. It is for your protection, and we'll get into it. During those 5 years, anything that's sold, any cash flow, all goes back to the investors. If there is anything left, if there are any assets left at the end of year 8, it must be sold. Typically, funds might have one asset left, but you've already gotten all your money and all your profit left. And there's an option with a majority vote for a 1-year extension on the fund in case that asset's not quite ready to be sold yet. But again, at that point in time, this is not binary. You'll have sold usually all the other assets. There might be one left, and it might get split off. There's a lot of ways to do it. Usually it's a very good asset or a very bad asset. But there's a reason you're not selling. Either it's producing an incredible amount of cash flow, or it needs a little more distress. Any more questions? Okay. Yeah.
Would there be dividends along the way, like with the rents?
What was that?
Would there be dividends along the way, or on the rents?
Yes.
things like that?
So I will show you. the funds have their own discretion. I'll tell you what, I can only speak to what we do, is that once we start distributing, which for us should be around December, January of this year, we make monthly distributions. We've never missed a month, ever. All three funds have never missed a check. Now, sometimes they're not that big, sometimes they're not, but every month we have never not delivered. Yeah.
So as the years go, the distributions get higher, or when you sell an asset, you just get out a big distribution?
We kick it out. So typically what you see is this and then a lot of waves at the end, because as you start selling assets, the distributions will become smaller because there's less cash flow, so it'll be a lot lumpier. So they're usually relatively steady. Then you'll sell an asset, sell two, there'll be a big bump, and then while you're waiting, there's less cash flow, so the distributions will obviously be smaller because you have fewer assets. And then as you sell stuff, the distributions will get higher and higher. Does that make sense? Okay.
Can you also explain what's the difference between someone comes into the fund right at the beginning period, or someone comes into the fund at the end? So if you're saying you're open until July, is an investor leaving in January, someone's coming in July?
That was actually the very next thing we're going to get to. So somebody comes in.
Question about the fund. You said that you've never missed the payment. In how many years?
Well, Fund 1 started 7 years ago with the investment period. Oh, that was still I think Fund 1 is on over its 100th payment. And they're listed on the slide. There's so many now, I can't even keep track. But I think we've made, in total of the three funds, we've got to be over 200 distributions. But yeah, we've never missed, which is pretty good. I'm proud of it. My money's in there. So how does that work? So it would seem unfair so now you invest on day one, right? So in this particular fund, we wrote an email to existing investors and we got $25 million out of it. We started investing. We started doing it early because we thought this was a good time to invest. And those people invest, they're $25 million, they buy assets. And now somebody comes in July. Well, those assets we've owned for 18 months and they've appreciated, right? Makes sense. In the documents, we have set what's called equalization interest. And this is across all private equity funds, whether they be real estate, biotech, et cetera. And this came to be that people would set an unfair pump up of the fund. So I put my money in day one, I put in my $2 million, and now I say that $2 million, I think it's worth 5. So everybody coming in is going to put in 5 million. Well, that's not very fair, right? That's arbitrary, and I'm going to make a fortune on that. So a guy named Issam Salah, and this is right when I was starting at Credit Suisse, that started to get popular, created the concept, or he brought back the concept of equalization interest. And each fund sets an interest rate that subsequent investors must pay original investors, depending on when they came in the fund, a one-time payment of interest for going in first. In our case, it's 8%. So if you came in now and somebody came in on day one, you'd owe them 12% of what you were diluting them for. It comes to about 6%. I don't see any of this. Well, my 2 million sees some, but the rest goes to the other investors. Now, usually this works very well. Sometimes it breaks a little bit, and we were discussing that before, is we think that the current deals in the fund are worth a lot more than 6% more. So you have an arbitrage. So why would the initial investors allow this? Seems like not fair, right? The initial investors took the risk. They're not being fairly compensated. Well, one, they agreed to it, and they knew it was coming. But two is the most important reason. You don't go into a fund to be in 3 deals or 4 deals. The point of going into a fund is to limit your downside. Again, the point of going into a fund is not to count pie in the sky returns, but to limit your downside. When I see high returns, what I want to make sure of is that they are risk adjusted and that there is padding that we will not lose. That is the way we look at them, is that we are buying this cheap enough that we will not lose. So if you're only in 4 assets, you got a lot of risk. So now if you're a first day investor, which I always do as much as I can the first day, I have free money from subsequent investors. I get the benefit of being first, knowing I'm in there right away. And third, I'm going to get more diversification with other investors coming in. If you want to be last for a first time, you have more certainty. In this particular case, there are 13 deals in the fund right now. This deck's like 2 weeks stale, so we did buy another one. So you are getting the benefit of not prospective deals. You are buying those deals at their original cost. Any questions? Yeah.
How many deals do you expect to be in this?
We're going to try to do 18 to 22. So you will be very diversified. But right now we have some screamers. Yeah.
So you've explained what's good for the person who goes in first, and you've also explained that the person who goes in last is more certain. But what about the returns? How does it end up in the end, the difference between going in the beginning and going in the end? Because the person who went in the end had to pay a bunch of interest, 8%, whatever it is. So how does their total return, or the IRR, whatever you want to call it, come out in the end?
Good question. So the way that all funds, so just to make it loud for everybody, if you come in at the end and you come in at the beginning, how do we normalize your returns? So we look at returns on a fund level only. So let's say you come in for $100. He came in for $100. He was fully invested, and it's a full year, just 1 year. So your 100 buys you $92 worth of the fund, and 8 goes to Baruch. Everybody with me so far in the example? Your returns will be based on 92, so they will impact your returns. You are paying to have more certainty, or what you believe is more certainty. I'm going to show you what we own. You have to make your own decision, but if you believe so. So that will be your total return will be less. However, your IRR, which is returns based on a measure of time, should be higher. Assuming that the IRR of the fund is higher than 8%, then you have a massive advantage. Your IRR will be higher because deals will be sold closer to when you invested. You with me?
So you'll have your money invested for a shorter period of time, which increases your IRR in the long time, in the long run.
Sir.
So, but of course, what Peter's giving is an example.
I like your keeper.
What Peter's giving is an example of where you have a fund where the investment value goes up over the initial period of time. Right, and that doesn't always happen. You could actually be investing in a fund that might start off and then it goes down over that period of time, right? So it doesn't always work like this. The way it works right now, or the way it has worked, or the timing, at least for this specific fund, is really very, very favorable, because anybody who's been following what's been going on in the markets over the last number of years, when they increased real estate, when they increased interest rates now in 2022, that impacted on the price of real estate tremendously. And so price of real estate went down. There was a lot of deals out there where valuations went down as a result. And then they started the fund now, let's call it close to 18 months ago, which kind of like is at that perfect timing, or close to, let's call it, good timing in terms of seeing something at a lower valuation when the initial. And by the way, even for the initial investors, they're still getting a benefit out of it. Don't think that they're giving the money for free. They're still getting that X amount of percent of guaranteed money from anybody else who's joining the fund later on. So they're being compensated. They're not being compensated as well as the later ones if the investments do incredibly well. They're not getting, if the fund averages in a 20% IRR, right, you're not going to get compensated, because you're only going to have received that 8%.
But it's a sure thing.
Right?
That's why I go first.
Exactly. And so, it's like, and so you start off with less certainty because you only have 1 or 2 or 3 deals at the beginning, but then you get that diversification, and that's a really big part in general of all of these types of funds, is that, right, that's one of the main reasons why we support our investors going into funds like this, is because for the average small, whatever the small is, but like for the average investor to go in to real estate deals, you have to have a lot of money to be able to diversify properly if you're gonna go in individually. And most people can't do that, and they don't have the expertise to do that. And so instead, what you do is you trust and you try and find an appropriate manager, and then you go into a fund structure where you have a much greater level of diversification. So that even if a deal fails, and there will be deals that fail, trust me on that, there will be deals that fail, whether it's in this fund or in any fund, maybe not in this fund, maybe there will.
This one's looking good, but
This one looking good now, but it doesn't mean, but you're doing it because of the diversification.
Right.
Because when you have much wider diversification, so you're protected. And that's really so critical for the small investor. Because you don't want to put your money all into one deal, and then that deal is the one deal that like goes bust.
yeah. So 81% of deals that started in the vintage of our third fund, 81% of syndicated deals lost everybody's money. And then you really want to ask yourself is, and it doesn't have to be me, there's ability to get into, but if there's anything you get, I implore you to go into real funds, like, name brand funds. Please do that. It is too hard to pick this stuff. There's too many jokers out there. You're taking outsized risk. Someone had a question. Yeah.
Yeah, could you briefly describe what are the things that can go wrong to lose money in a property? I'm assuming you said that you buy distressed properties, right, in locations that you think it's gonna go up. Can you say something about what are the, like, I can imagine interest rates might have something to do with it?
Yes. So there's a very long conversation. So I'm gonna really, the question was, what can go wrong that you can lose money?
The question which is before all of these questions. Two main questions. Number one, could you give me an example of things that you have invested in? And number two, how do you calculate the returns that people are going to get on these investments?
No problem. Okay, so let me start there. And then not only can I tell you, we have listed in this presentation every single good, bad, ugly investment we've ever done with the returns and the explanation of the calculation.
And everyone will be leaving with this presentation and the complete booklet printed out, so you'll be able to take it home and review it also at your own pace, leisure, and then come back with if you have any questions as well.
And for further, not only do you have them all listed here, we have a separate deck with a description of all of them, and the longest description is the deal we lost money on. It is, because it's the most important one. It's the most important. So how can you lose money in a deal? First way to lose money in a deal. This is an easy one.
Pay too much for it.
Right, you pay too much for it. You're dead on day one, or you develop it, and you just get eaten by time. Time is the enemy of development, because you're paying all this interest rate, and you're not going to get any money. So you pay too much. Number two, on a macro scale, right? Let's talk about things you can't control. Interest rates go up, way up. However, if you bought it cheap enough, you will be able to withstand it. You will have time. If you bought it on the margin and you were hoping that a lot of things were going to happen, you're dead. So I think to crystallize what can go wrong in a real estate deal, there's an enumeration of things that could go wrong. But here is the one way that I've seen the most people lose money: trying to thread the needle to make a return. Trying for too many things to happen, which all comes from buying it too much. If you buy something for too much money, a lot of stuff's got to have to happen right. Your rents have to go up. Your occupancy has to go up. Your interest rates have to stay down. There has to be available capital out there. There's an enumeration of things that must go right. So what I've seen the most, instead of going through everything that can go wrong, because that's a million things, is not having enough padding on the deal, hoping too much is going to happen. Now, how do you insure against that? Number one, buy cheap. Number two, stable assumptions on the exit. So in real estate, we use something called a cap rate. It is the inverse of a multiple. If you're going to sell something at a 5% cap rate, that means it's going to sell for 20 times earnings, 20 times the net operating income. so that the next person would have a 5% unlevered return. If you were going to sell something at a 10 cap rate, it would be a 10 multiple. With me, an 8 is a 12, a 6 is a 16.2, 16 and 2/3, et cetera, et cetera, et cetera. So what we see a lot is the one thing that you could arbitrarily put into any calculation is throw in a low cap rate at the end. I can make any deal work with a low cap rate. You put in a 2 cap, you could buy anything, right? You could buy a rock and make it work.
If you ever see something with a 2 cap, please run.
In fact, you ever see anything with a low cap of 6 or lower? We always say if it's got a 6 or lower, this thing better be a 30 IRR. We model our deals at high caps. Why do we model them? Because you'd be surprised they actually usually end up there. They actually end up there. I'm sure we've all sold something for a low cap, but I think that my cap is defensible, and I will take the Pepsi challenge with anybody that throws out a 5.75 cap. And if it's a 5.7 cap, mazel tov. No one will be happier to be wrong than me if it sells at a lower cap. But I don't require a lower cap to make my deal go. So for instance, I have it at an 8 cap. I'm going to make a lot of money. Another guy's got it at a 5.75 cap. If they go to an 8 cap, wipe out. Not a good place to be. If I go to a 5.75 cap where they're just getting their 18 and I got like a 60, I'm in a good place. So it really comes down to defensible assumptions. Another thing that we like when it comes to rents is never bet on the entire market rent going up. Again, never bet on the entire market's rent going up. Take an asset that's next door, and if the guy next door is getting $1,200 and you're charging $1,000 and you have comparable product, but this is charging $1,000 because the bank wants higher occupancy or they're nervous or it's not well managed, that's defensible. I'm not betting on the market to go up. They're getting it right there. That is something you can invest in. But if I go in there and say, well, the 1,200 guy's going to get 1,600 and I'm going to match him and we're both going to get 1,600, that's when you start to get into trouble. So there's an enumeration of things we could talk about, but the general idea is buying it at such a high price and hoping that too many things happen. Buy cheap. Yeah.
You said that by the end of the 8 years, everything has
So I'm a hearing aid guy, so I'm coming close to you.
You said that by the end of the 8 years, everything has to be sold.
Yes.
How do you know that when it comes time to sell, that you're going to be able to get the price?
Got it. You don't. So the answer, the question was, at the end of the 8 years, something has to be sold. How do I know that everything's going to sell at the price I predicted? The honest answer is I don't. Nobody really does. But how do you defend against that, right? So our deal life is usually 3 to 5 years. So when we buy something. So what will happen, so that's first of all the time frame. How do you determine if it's sold at that price? You don't. You can't. But what you want to do is do something called the marginal IRR calculation. And that is a little complex for this discussion, but you want to look at your incremental returns as if you sold it today or your investors had that cash today, how much they can make on their own or how much you can make extra. If holding that asset is the equivalent of what the return would be upon sale going forward, then you hold it. If it's lower, then you don't. So when the marginal IRR, when the future earnings by holding that asset, because if I could sell an asset, I buy it at 10, I could sell it for 20. Let's say it's making $1 a year. I'm not making a 10% return. I'm only making a 5% return because you could have that $20 in the bank. You follow? That's a very important nuance. I was like, well, I'm still making 10% on my money. No, you're not. You could have sold it right there. You have 20 bucks. You're only making 5% on your money. So that's the general calculation is what we use. But can I promise you that everything's going to happen like it is or even close to it? No. Does my track record specify that I'm usually pretty good at it? Yes.